welcome back to the fourth edition of the Kansas City Commercial Real Estate Market Pulse, sponsored by Exchange Commercial Real Estate. Lots going on in the economy and in the commercial real estate space. And we're excited today to really dive into a lot of these topics that have been brought to our attention from speaking with property owners, with investors, with other folks in the industry. And it's our goal and our aim to deliver valuable, up-to-date information on the commercial real estate market. Look, I mean, there's nowhere else to go on a bi-weekly basis to figure out what's going on in real time. And so we want to make sure we're getting the information out to all of our clients and our prospects and all the folks that we do business with on a regular basis so you can make informed decisions. We're going to be covering new market listings, different trends that we're seeing, big transactions. We're going to go over overviews. We're going to have expert insights. For example, it's a good time to tease out in September on the date and the week of the Federal Reserve's next meeting. We're going to have a capital markets expert here delivering up-to-date content for you in regards to figuring out if you need to hold your property, sell your property, refinance your property, and if right now is a good time to do that. Our goal is to position ourselves at Exchange Commercial Real Estate as the go-to resource for market intelligence and industry leadership in the Kansas City metro area. I'll be joined on a regular basis by a lot of our team members, which you can find here on this slide. My name is Logan Freeman. I'm the managing broker of Exchange Commercial Real Estate. Today, right now, we may have some other folks trickle in here. We have Katie Cobb, who's our brokerage coordinator. Katie, how are you today?
I'm great. Thanks for having me on.
Absolutely. And if you do any business with Exchange Commercial Real Estate, you will be interfacing with Katie on a regular basis. So thank you for being here. She also is the one that is putting together all of this great information for us on a regular basis, which is no small undertaking, I will tell you. Every 2 weeks really does pop up really quickly. We're also joined by Nathan Roberts, who is one of our broker on the investment sales side, leasing side for multi-tenant retail, flex, industrial, and office space. Nathan, how are you today?
I'm doing great, man. I'm excited for this show today.
Yeah, I think it's going to be very timely in regards to what we are covering. You'll also see Max McQueen, Mike Habibi come on every so often and talk about the multifamily market, and Nick Morales in regards to general market trends with business owners. We're working on a lot of land opportunities here as well at Exchange Commercial Real Estate, and Nick will be involved in that. And Chad Kagi, who's our broker on the healthcare side. So if you are a dentist, a chiropractor, a doctor looking to figure out if you need to lease your space or you should work on buying your space, or you're looking for an expansion opportunity in the medical field, Chad is definitely your guy. So have a lot of the main food groups covered here at Exchange Commercial Real Estate. And, today, last week was great because it was the end of the month. We could really go through kind of a July roundup, any notable transactions that we saw. And we spent a lot of time on that. And I thought that was very beneficial. But with everything going on in capital markets, with the economy, with the financial markets, it's really difficult, and it's a complex scenario to try and understand what you need to be doing to position your portfolio accordingly. And so today, we're speaking on the economy. We're speaking on Kansas City, how it is doing, how different asset classes are doing, and the notable trends that we are seeing in real time. And we're going to pair that up with conversations that we're having with property owners, developers, investors, and other vendors in the networks that we have to bring anecdotal evidence that back these claims up or refute them, right? Because we can't take everything that we read, we all know that, in the media for 100% truth. So very excited about that today. I think it's going to be a great show. And if you do have questions or comments, please feel free. We are live here on LinkedIn, and we are live on YouTube. So if you have comments or questions, we will be monitoring the chat. So feel free to post those comments and we'll get to those later in the show. So without further ado, let's go ahead and get started and talk through what's going on with the economy. And holy cow, what a roller coaster ride it has been the last 2.5 to 3 years. And there's no shortage of headlines for us to really dive into. So finding the right information to bring to you took a lot of time because we had to wade through a lot of stuff to be able to get a good theme going on here. But if you've been watching the financial markets, they recently took a downturn. And that continued for the last couple of weeks following the release of the July jobs report. And you're going to hear us key in on jobs a lot today. Why? Because jobs really do fuel the commercial real estate market. If you think about residential and multifamily, you think about office and where people need to work. You have industrial as well as retail where people are shopping and what's going on. And more jobs, that fuels different types of growth and development, which is important not only for the real estate market at its core, but for investors that are looking to enter into the Kansas City market. So this latest job report revealed that job growth has been slowing to 114,000, which is significantly under the expected 175,000 jobs, and it makes the weakest increase since October of 2019. Right. So that's a big marker that I have seen a lot of economists really honing in on and trying to understand. Some saying, holy cow, this is the start of the big recession and everybody needs to get ready. And some others saying, hey, this is not that bad. And, this was to be expected. Right. But one thing we do want to talk about is the unemployment rate, which climbed to 4.3%, reaching its highest level since October of 2021. So apart from the pandemic period, unemployment hasn't been this high since September of 2017, when it was still gradually declining after the Great Recession. This came on the heels of a report from the Institute for Supply Management, which highlighted a sharp decline in manufacturing employment in July. Okay, now there's a couple things here to think through. If you're an investor, if you're a property owner, the unemployment rate at 4.3%. Historically speaking, we're not in any territory that we need to be extremely worried about in regards to warning signs. Also, what we're going to dive into is going to be talking through the labor force and how it has been increasing, right? So if the labor force increases, then the unemployment rate can go up, right? And so I think that is something to keep in mind, right? There's always a yin and a yang on economics. And I remember in my master's program reading through all of the economic textbooks, and just because one marker does go down or up like the unemployment rate, there's always something on the other side of that causing that, just like supply and demand is extremely important in real estate. So anyways, I wanted to kind of just say that people and a lot of market experts are looking at this as saying the economy is beginning to show signs of exhaustion, right? Well, let's dive into that monthly jobs report, because I think this is important for us to really understand. Markets reacted with alarm. The Dow Jones Industrial fell by 4% by last Monday's close, and the S&P 500 index fell by 4.8%, and the NASDAQ lost 5.7%. Here's one that we're really keying in on. The yield on the 10-year Treasury, which had already dipped below 4%, for the first time in 6 months, it plummeted to 3.79%. Well, Nathan, tell me why the 10-year Treasury is an important marker for commercial real estate investors and why they are always keying in on that metric.
Yeah, I would say it's really important to remember that banks have like a spread that they need to make. Typically, it depends on the bank, but you might be about 150 to about 250 basis points above that number. So that's why it's very important to see what that number is going to be, because that directly impacts what your interest rate is going to be when you take out a mortgage.
Absolutely. And by a couple of weeks ago, the yield curve, which had been inverted for the past 2 years, and which often foreshadows a coming slowdown, had de-inverted. So that was another big claim to really key in on. And this is a really interesting rule, the SOM rule, right? So the SOM rule was triggered. which stoked even more recession fears. Now, I did a little more research on this, and the lady who actually came up with the Somm rule, Claudia Somm, she really said, look, this time is different, right? It's like the exact words we always hear from an economist, right? It's like, but this time is different. So the rise in unemployment, fed into recession fears, and the so-called Somm rule was triggered, and that was coined by Claudia Somm. This rule has shown that when the 3-month moving average of the unemployment rate exceeds its low over the past year by 0.5% or more, the economy usually has been in recession. So since 1953, the rule has been triggered 12 times, including this one. In the previous 11, only in November of 1959 was the economy not already in a recession. In that case, the recession began 5 months later. So most of those recessions, however, came after several months of job losses, which caused the unemployment rate to rise. That has not happened in today's labor market. So economists regard the situation today differently. The labor market has seen a wave of entrants through migration and women returning to the labor force, adding to the labor supply and the unemployed, rather than a rise in job losses adding to the unemployment rolls, right? So that's really a really big factor here is the labor participation rate has been increasing, which is a good thing, right? I mean, that during the COVID-19 pandemic, it was very difficult to have people working and getting people to work, right? The labor participation rate really was at an all-time low. And so seeing people come back into the workforce is extremely important because commercial real estate is not just about transactions. It's about development. It's about construction and all of the trades that are involved with that. Katie, Nathan, were there any comments that you guys had in regards to the Somm rule being triggered or the monthly job gains that stood out to you guys?
No, nothing super surprising on my end. I mean, obviously, you're going to have some gains, which is it's a little surprising to me, just knowing with the amount of layoffs that we've seen across the board with just the tech industry.
Yeah.
It's a little surprising, but like obviously, I mean, I always say lead with intuition and data. That's what actually gets you results that you want. So
exactly. I always say facts tell and stories sell. Right. And yes, there are a lot of facts here, but you have to look a little bit further to understand what the story is. Well, let's look at what some of those current labor market trends are, right? So recent recessions often followed months of job losses. This has not occurred in the current labor market. And today's labor market sees increased labor supply due to the migration and more women entering, not in job losses. So keep that in mind. Economic weakening is expected after the Fed maintained high policy rates for a year to curb inflation. Let's not forget the fact that major fact. This is one that a lot of people are really keying in on, right? Inflation dropped from 7.1% in June of 2022 to 2.5% of June of 2024. So economic activity has definitely slowed, right? And so the labor market's showing signs of softening. July jobs gains were weak. May and June payrolls were revised down, which is not out of the ordinary, down by 29,000. Average hourly earnings growth has slowed over a year, meaning that jobs are more competitive right now. And the unemployment claims rose to 249,000. That's the most in the year. Continuing claims reached 1.9 million, which is the highest of November of 2021. But I don't think anybody should be surprised to see the economy weakening. After all, the Fed has held its policy rate at a 2-decade high for a year, aiming to cool the economy and to calm inflation. Proof of this effectiveness is materializing, right? With inflation coming down from 7.1% to 2.5%, right? And so I think that all of these components combined, everybody's got their eyes on what the Fed is going to do in September, which is a very interesting component because if you look back 6-7 months, we thought we were going to have rate cuts much earlier than September of this year. And a lot of people got excited and had a lot of optimism around that. And we'll talk about why that is important for commercial real estate here slowly. But even so, economists point to continued strength in the economy. So the Commerce Department recently reported that economic growth reached 2.8% on a seasonally adjusted annualized rate in the year's second quarter, far faster than expected and twice the growth rate in the first quarter. According to the Atlanta Fed, early estimates for growth in the third quarter about 2.5%. Moreover, while on a broad cooling trend since late of 2021, the ISM survey of services activity improved in July, and the Department of Labor reported a 2.3% advance in labor productivity in the second quarter, which is well ahead of the expected 1.7% increase. So, what are we watching right now? Well, we're watching about the impact of Treasury yield drop. With a drop in Treasury yields and renewed market anticipation of Fed rate cuts, the average 30-year fixed mortgage rate fell from close to 6.8% last week to 6.34%, according to the Mortgage News Daily. That's the rate's lowest level since April of 2023. So that news could help to reinvigorate the morbid housing market, improving affordability and boosting economic activity typically generated when home sales rise, such as purchases of appliances, furniture, and spending on financial services. And many people are saying relief cannot come fast enough. But, I want to ask you, Nathan, what conversations have you been having with investors and property owners around just the economy in general? What are they watching? What are they seeing? What are you hearing from them in those conversations?
I would say the number one thing is that people are anticipating like what that basis point drop in interest rates are going to be. I'm hearing around the board anywhere from 25 to probably 50 basis points. Some think that it's going to be higher. I don't think it's personally going to be higher, just simply because you don't want the rates to drop so fast to the point that inflation becomes a reoccurring issue. That's just that when interest rates typically drop, then that's when more investors, or let's just say home buyers, flood the market and they start acquiring things because it's cheaper to borrow.
Yeah.
But I would say that's probably the sentiment that I'm hearing, just talking to a lot of business owners and investors.
Yep. I've also been hearing that the continuing trend of onshoring is still driving a lot of demand in the flex and industrial space, because people still wanting to get more control of their supply chains, but labor still being a real challenge in a lot of those different trades in the construction side. So roofing, electrical, HVAC, those types of trades, it's really still a hard place to find laborers in that sector. Katie, wrap this section up for us here. What are we watching? What are you hearing? What are you talking about in regards to the economy, and what are you seeing?
So you actually showed me John T. Chang on LinkedIn, so I've been watching his videos. And so it's kind of a mixed bag right now. Like he was saying, it really depends on how you review the reports and what you take from it. So like great news is that inflation is down. Bad news is that unemployment is up, but that puts the pressure on the Federal Reserve, like we said, for September to hopefully reduce those rates. So he actually was talking about it that really when that job report came out in July, that he thought of it kind of like the Olympics, that it was the 100-meter dash, that the investors took off at that point, like racing. And he said the ones that are ready to go on the sidelines will be ahead of the curve here, because he said that it's really the commercial industry is really kind of thawing here, because the debt will finally make sense again. So I think, again, like we talked about last week, with it being 2 weeks ago, with it being an election year, it puts just a whole nother component into it. So I don't think that we're done seeing the end of these reports before the election. I think that it'll take another turn, but hopefully good for the economy and investors. I know that's kind of hard to benefit both at the same time, but we'll see.
Yeah, absolutely. I think that's well put. Is the commercial real estate market is starting to thaw, and I am seeing renewed vigor in activity across the country in a lot of different sectors. And so, as the September meeting with the Fed comes, I do think that is going to continue, and there's going to be a strong Q4 and even going into next year. I do not believe that the bottom is here. A lot of people are calling the bottom right now. I do not believe that is happening. And I am in talks right now with the group that has created the most up-to-date information in the 18.6-year real estate cycle to come on to the Kansas City Market Pulse to discuss where they believe we are at right now in the current 18-year economic and property and land cycle. which would be extremely valuable, because if you can study the history of land cycles and economic cycles, you can understand better where we might be and position your portfolio accordingly. So that's why all of these things, jobs reports, unemployment rates, the treasury yield, are important to understand, because those are indicators on where we might be in the larger cycle, especially in the larger long-term debt cycle, which is what Ray Dalio talks a lot about. So stay tuned on that front. If I can't get them, or they are extremely expensive to come on and speak with you all, we will most definitely do a deep dive into the 18.6-year real estate cycle, and I will do the best job that I can overviewing that and giving my opinion on where we are at in regards to that. But let's talk about that, right? Let's talk about how people are comparing now and the 2008 and 2010 real estate collapse. In subsequent episodes, we will go through the similarities and the differences of these, but we want to take a historical approach here. So let's dissect what happened then to see what we can learn. The real estate crash of 2008 didn't just happen overnight. It was the result of a perfect storm of subprime lending, market speculation, and economic fragility. So here's a breakdown of how it all unraveled and the steps that led to the Great Recession. And understanding this framework could be the key to avoiding similar pitfalls in the future. So number one, the subprime mortgage crisis. Lenders were handing out risky loans like candy on Halloween. Subprime mortgages were given to borrowers with poor credit. Many of these loans had adjustable rates that skyrocketed. Borrowers could not keep up with those payments as rates increases. So when those mortgages defaulted, the market began to crack. And then the domino effect of foreclosures happened. The defaulted mortgages led to mass foreclosures. So homeowners were underwater, meaning they owed more than their homes were worth. So foreclosures flooded the market with distressed properties. Home values plummeted as a result, and that caused a downward spiral in home prices. That led to the financial system meltdown, where banks were neck deep in mortgage-backed securities. And these securities became worthless as foreclosures surged. Major financial institutions faced massive losses. And this triggered the collapse of companies like Lehman Brothers. The Lehman Brothers and the financial system nearly collapsed under the weight of those bad investments. And then what happened? Government intervention. The situation was so dire that only drastic measures could stabilize the market. The Troubled Asset Relief Program, or TARP, was introduced. The Fed started buying mortgage-backed securities. First-time home buyer tax credits were offered to stimulate demand, and these efforts gradually helped stabilize the market. So understanding those triggers and responses to the 2008-2010 collapse can help us prepare for future downturns. By analyzing those events, we can spot early warning signs in today's market, which is exactly what we are doing on the Market Pulse on a regular basis with the treasury yield, the uninverted or the de-inverted yield curve, with the unemployment rates, as well as jobs. And I think that's really a great point to make, because that stuff happens in real time. Now, we're not going to get into the similarities and the differences between the two just quite yet. That's going to come in later episodes, but we did want to set the table and say, look, this is what led up to the 2008, 2010 great financial crisis. Lots of things are different, but we are in a different period of time in the market cycle as well, which is also something to understand. And there are different components here that we're dealing with right now. Nathan, you left a great comment on my LinkedIn post that I put out with, which, by the way, if you're not following myself or Katie or on Nathan on LinkedIn, please go follow us on LinkedIn. We're putting out great content. Nathan's got great videos that he puts out on a regular basis. Somehow, some way, I just had one of my videos go somewhat viral, and it's got over 85,000 views on that. I'm wondering if LinkedIn didn't just want to give me a little dopamine boost and somewhat show that post to a whole lot of people. But hey, whatever. Hey, we're going to stay active and we're going to stay consistent on LinkedIn. But Nathan, talk to me about your comment on this post and what you were thinking through when you saw me talking about the 2008 housing crash.
Yeah, I was saying that there are some similarities between like what happened in 2008 with the Great Recession and now. My comment was mostly geared towards asset classes. So I think it's really going to be asset specific on where the downturn's actually going to be. I mean, we're still seeing great fundamentals with multifamily, industrial real estate, and retail. I think really, and this is the thing that has been probably since COVID, is office, and just with increasing amount of people that are working from home or in some sort of hybrid model. I mean, I think long term that's probably, or I'll say short term. We don't know exactly what's going to happen long term, but short term for sure, that's going to drive down demand for office properties. And vacancy is directly tied to what the value of a property is. So as the NOI goes down, I mean, properties are going to be worth a lot less, specifically with office. And that's what I was mentioning, is that it's really going to be asset specific. With housing, fundamentals are there. Pretty much every asset class fundamentals are there outside of office. And I think there's a lot of opportunity to come with office as well if you're able to buy at a very low basis. So I guess more on that later.
Absolutely. Katie, you lived through 2008, 2010 housing crash, and you remember what was going on in the real estate markets. Tell me about what your feelings are right now.
It was so different. So I actually got into real estate back about 2007, 2008, and I was working for a new home builder. And so what happened to save us at the time was obviously we weren't in the Sun Belt states, which kind of took, a big hit. But that first time homebuyer tax credit, and just I still just don't think that we have the inventory that we would see something similar, but I don't know. Again, it's an election year. Like I keep going back to that. It's an election year, and they keep talking about it being, a soft landing or a full-blown recession, that they'd have to bring in programs like the first time homebuyer tax credit. So how do you feel about the inventory being there?
Yeah, I think that one of the slides that we're going to cover here shortly is the great amount of inventory that has come online or is coming online on the multifamily side, and how that might impact things. So we'll get to that point here very shortly. I appreciate the input there, guys. Here's a thought-provoking question. Is bad news in the economy actually good news in commercial real estate, right? So latest reports have shown a mixed bag of inflation still coming down, retail sales are still strong, but we just walked through a lot of the different metrics that the economy is losing momentum. The unemployment rates has increased by 20 basis points to 4.3%. But in general, inflation is still coming down, and that's pretty much good news no matter how you cut it. But we're still seeing a lot of those metrics that suggest that the economy is losing momentum. But because so many of these economic metrics are showing signs of weakening, it's putting increased pressure on the Federal Reserve to reduce rates, which for commercial real estate investors is good news. So I have a question for you both. Is the U.S. still facing a recession, or is a soft landing, in the cards? And if the economy is doing worse by some of these metrics, should investors and commercial real estate investors be excited about the possibility that might help properties and the commercial real estate market? Nathan, I'm gonna pass that over to you.
Okay. No, that was somewhat of a long-winded question. Can you actually repeat that question?
When you're speaking with property owners, they may conflate the idea that, yes, the economy is weakening, and there are a lot of metrics that may prohibit their business and or investment, but that news in the economy can actually be good news in the commercial real estate side. So are you having conversations with property owners where they're waiting and they're excited about the economy not doing so well because it actually might help their property investments? That's the question.
Yeah. I think it really depends on the asset class again. I mean, when you're starting to see like consumer spending, like those changing dynamics, like consumers not spending as much in retail brick and mortar, but spending more on online. I mean, that definitely helps with the fundamentals, or definitely helps with industrial real estate. Doesn't help so much with retail, but it can be counterintuitive. but it could be a great thing for some property owners and a bad thing for others.
Yeah.
For example, like when it comes to office in general, like flex industrial is doing great. Office users can sometimes lease flex industrial space, but not typically vice versa, just because flex industrial, just like the name, it's very flexible. It can be catered towards retail users, it can be office users, or it can be a combination of warehouse in office or warehouse in some sort of retail showroom type of space. So I think it's ups and downs, really depending on what asset classes you hold, which is why it's always great to diversify your portfolio.
Yeah, that's a great point, because commercial real estate gets lumped into the same one large market, right?
Yeah.
But inside of that market, there are so many different sub-markets, not just geographically speaking, but asset type specific as well. And that is increased complexity into decision making, which is important to know and be in touch with folks like yourself, Nathan, so you can get the most up-to-date information and what is the actually, the supply and the demand of that type of space. The other part that I would say in regards to, is bad news actually good news in commercial real estate, is that in regards to the largest capital stack component, which is your debt, typically, we will start to see, if the Federal Reserve does remove that or lower that benchmark on the prime rate down, and they do lower that, we will start to see higher property values, because people will be able to make sense of investing their capital at that rate, right? And so I think that's an important thing to think about. We have some positive trends for commercial real estate investors. That's being, economic durability, economic softening, decreasing cost of debt. The expectation gap between buyers and sellers should be narrowing. That has been a very large gap for quite some time. And if the debt does come down, then that gap will continue to decrease, which will allow folks to actually get transactions done in the market. So I think that you have to stay, just like John T. Chang always says, you have to keep your eyes on the horizon. And that's what we're doing here on a regular basis. Now, let's talk about Kansas City. The latest data shows a 2% job growth over the past year, which places Kansas City in one of the top 15 metros nationwide. We had 22,700 new jobs added on the non-farm payrolls, which has reached an all-time high of 1.6 million. This isn't just great news for the local economy. It's a game changer for commercial real estate investors in the future of our market. And smart investors follow the jobs, right? The unemployment rate in Kansas City is right now at 3.8%. And that's up from its recent low, but it's similar to that of Boston and Pittsburgh. A tight labor market has brought people back into the labor force, and the number of people in the labor force is the second highest in history at just over 1.19 million people. And that record occurred in July of last year. Additionally, the region's retail availability rate dropped to a historic low of 4.7% at the start of the third quarter because of absorption, or the change in the number of feet occupied, reaching 936,000 in the past year, which is 38% above the average over the past 5 years. Now, Nathan, that is a fact and a data point that is extremely important for investors to understand. The region's retail availability rate has dropped to a historic low of 4.7%. Why is that happening in Kansas City?
Yeah, I would just say that, spaces are typically getting leased up, then they're getting leased up faster than what's actually coming available on the market. And that's essentially what net absorption is. It's that difference between what came available in a 12-month period compared to what got leased. Specifically with retail, there's the demand is a lot higher than the supply out there. And I think that's why we're seeing increased rental rates for retail, and along with very historic lows when it comes to vacancy.
Yep, absolutely. And just to put a button on this, robust job growth fuels commercial real estate demand, and Kansas City's expanding labor market drives demand across all sectors. 8 out of the 10 sectors saw annual growth, right? Leisure and hospitality sector is booming here in Kansas City, with jobs up 6.6%. And this surge in employment supports retail and industrial space absorption, which is exactly what Nathan was just talking about. Investors are seeing strong returns in retail and industrial properties, right? Opportunities in a tight market means that Kansas City's labor force is the second highest in history. So more people entering into the workforce driving economic activity. And that tight labor market indicates sustained demand for commercial spaces. So keep your eyes on the labor markets and the markets that you are looking to invest in. And this is exactly what we were speaking about previously, which is the United States apartment market is gearing up for record-breaking deliveries in 2024, right? We have over 518,000 new rental units expected. That's a 9% increase from 2023 and a 30% rise from 2022. That's enough to house the entire population of Atlanta, right? Great job with that point, Katie. And I was curious to know and to think about, what does this mean for the market and for future development trends? Well, just kind of compounding on that, you can see this graph, right, of the historic high in 2024. But look what happens in 25, in 26, in 27, and 28. Why are we seeing such a big drop off in new deliveries? Well, what's happened right now in the last 18 to 24 months? Debt has gone through the roof. And so to develop new projects, again, your greatest component of the finance and the capital stack is going to be your debt. And if that is up, then and I'll pair that alongside rising construction costs and labor costs, then that is going to put a damper on new deliveries. So while we're seeing a large delivery, historic highs in 2024, it drops pretty drastically in the following and subsequent years. So from an acute standpoint, we may have some pain in regards to all of the new deliveries and how that might impact. But from a long-term perspective, we should be right in line with historic norms, and our absorption should be in good spaces, in good spots. Now, where are those new deliveries actually coming online? Well, New York, Dallas, and Austin are at the forefront. New York leads with nearly 33,000 units. Brooklyn alone is going to account for almost 30% of New York's supply. Dallas and Austin contribute 10% of new apartment units nationwide. So the momentum continues, but with caution. And I wanted to really paint the fact that we're going to see 33,000 units come online in Kansas, or sorry, in New York City, and Brooklyn alone is almost 30% of that. Katie, how many units do you think that Kansas City is delivering, and how many units do we have under construction? I'm going to put you right on the spot.
I was like, thanks for that one. I know we have a lot under construction. I know we have a bunch being delivered, but obviously it's not 33,000. I wanted to say that we were more like 1,800, 2,000 this year. Is that
so
right?
The forecasts in 2024 are right around 4,500 units. Right now we have 6,100 units under construction. However, area vacancy has ticked lower in recent months, and the rate has dipped by 10 basis points during the first quarter to 5.5%. So year over year, vacancy is also down 10 basis points. So we've operated between 5% and 6% during the past 3 years. However, asking rents, so this would be on the new deliveries, have declined by 0.7% during the first quarter to about $1,182 per month. But as we all know, and what we have presented here previously, just because the asking rents haven't gone up, area rents are still rising, and rising to the tune of about 1.2% in the last 12 months. So that is a good metric to keep your eyes on. So keep in mind that while New York City is bringing on 33,000 units, Kansas City is delivering 4,500 new units, and our vacancy rate is still right around 5.4%. So we are and why Kansas City and the Midwest has been such a hot market for rent growth is because we have not had the major supply as some of those other markets like Austin, New York, Dallas, Phoenix, and Atlanta. So I wanted to pass the baton over to Nathan. Nathan, you recently went to the Real Estate Journal's Industrial Real Estate Summit. Yeah. Talk to us a little bit about what you found out there and thinking through what Kansas City needs in regards to better infrastructure. What were some of the trends that people were talking about?
Yeah, so I would say the ongoing trends. I mean, there were the event was broken off into three different sections. I would say an ongoing trend that I keep hearing is the complexities with what industrial tenants are actually looking for in order to actually get them to Kansas City. I mean, infrastructure is the number one thing. I mean, you're looking at water, you're looking at sewer, and you're looking at power, electricity supply. And electricity supply is probably the biggest hindrance to larger industrial players coming here, or those that are coming from international countries. So really that's probably the biggest thing that Kansas City really needs work on, and that's why we're seeing these projects popping up on the outskirts of Kansas City like DeSoto or in the Northland, because it's easier for them to actually have that power supply added, even though the time horizon is still going to be that 18 to 24 months.
Absolutely.
If you were here in the city, number one, there's not enough land for these large projects, and the infrastructure isn't built out for these projects.
Absolutely. And I love the fact that the key areas of growth are including Shawnee, Lee Summit, Belton and Raymore, and DeSoto, Kansas, right? I mean, Lee Summit is significantly behind on tax abatement, lagging by 10 years. And one thing to keep everybody's eyes on is the land that has come for sale from the church over in Lee Summit that had thousands of acres that is going to be developed here recently. And that's to keep our eyes on what's going to happen with that. I would imagine we start to see some pretty sizable projects popping out there as well. But I saw that there was also a trend of, large scale projects really being struggling. And a lot of the projects have been smaller in footprint and a little bit more complex. But what do we mean in regards to they're more complex and the current the deals that are tending to be done are smaller? That makes a lot of sense. We've talked about the spaces not being developed in regards to the smaller spaces, but on the complexity side, what's creating the complexity in these deals?
Yeah, so I mean, specifically for Kansas City, there's been a huge increase in the amount of food and beverage industrial players that are actually coming. I mean, figuring out the mechanicals and everything that goes into food and beverage is very complicated. It's not a field that I'm particularly playing in. But a lot of developers, just knowing that most of them are doing build a suit right now, that's like the number one industry that I think is coming to Kansas City or is just growing at this point.
Yeah, absolutely. And let's highlight a couple of the top industrial developments in Kansas City right now. Nathan, which ones have your eyes right now?
Yeah, I mean, the three that I'm most excited about is the Google. It's not a Google plant, but it's like a Google. It's very similar to the Facebook Meta project. How
Sure.
It's more geared towards infrastructure, but more for online cloud-based technology.
Yeah, data center kind of focus.
Yeah. So that's the Google. Panasonic. That is in DeSoto. That is the power plant. Or not a power plant, but it's for the charging ports.
Yeah, EV battery plant, right.
And then that third one that I'm super excited about, this is one by Hunt Midwest up in the Northland. It's an industrial commerce business center, and that's really more logistics in warehousing for large industrial tenants. So I want to say this project there is around a couple million square feet and is one of the largest ones in the KC metro.
Yeah, absolutely. So Kansas City's needs sewer, water, electricity. The capacity determines if large or international tenants are going to come to our market. Kansas City needs better power and electricity capacity in order to compete. So three possible solutions, right? Upgrade power, investing in modernizing and expanding electrical grids and facilities, streamlining the permitting process, right? I mean, simplifying and speeding up the approval process for power projects, and then offering the incentives. You got to provide certain incentives and subsidies to encourage power and infrastructure investments. These are all components that are going to continue to drive Kansas City and the submarkets around Kansas City. The point being that if you connect with myself or Katie or Nathan, we have the knowledge and the experience and the intel on what's going on in these submarkets and what are some of the constraints are to help you position your portfolio accordingly and really target specific areas. Now, guys, we have some questions to cover in regards to the commercial real estate market in Kansas City, but I'm going to ask both of you one question. And the question is, if you had a crystal ball and you had the ability to buy any type of property in any type of location in Kansas City metro area, what would that be and why? Katie, let's start with you.
Oh, that's a hard one. Obviously, we've talked about there's such a demand right now for flex industrial. It's just hard to find the smaller flex industrial. My heart is still always with multifamily. I just think that it's a great investment, especially places that are attracting. Like I keep thinking about DeSoto, Kansas, with them bringing the $4 billion plant, and all the jobs it'll create, just the housing down there alone. But I think that if I were an investor right now with capital to deploy, I'd be super excited about that. The 10-year treasury and the cap rates are starting to make sense now that we see some economic softening. So I think that I would be ready to look at places like you said, like Lee Summit, also North Kansas City with all of its growth for multifamily. And then we still have kind of the whole like where the Chiefs will go. And when they do, the hospitality projects that will go with it, if they decide to stay where they're at, or if they go over to the KCK side. So that'd be another place that I'd be looking to deploy some capital here.
Great insights. How about you, Nathan?
Yeah, I'm going to piggyback on that. Flex industrial is really, it's just in such high demand just due to its versatility. Another thing that I feel like this is something like nobody else is saying, but office. Like if you can find an office building with a very low basis, specifically between 5 and 30,000 square feet. And the reason why I say that square footage is because a lot of office tenants specifically want to be in a building where there's only a couple tenants, or they're looking to be in a larger tenant or a larger multi-tenant building that has all of these amenities. But if you can buy an office building in a great submarket or great location, and you're able to buy it at a very low basis and put majority of your capital stack into improvements to increase the amenities, and also just make it easier for I guess the tenants to actually bounce some of their customers off of one another. I think it's a great play that a lot of investors aren't even thinking about. Just essentially buying at a very low basis and doing what you can to increase the improvements. That can be through tenant improvements for specific configurations for a tenant, or just increasing the amenities in that building, because those are really the things that office tenants are looking for. The fundamentals are still there, but it's just that if you have a B or C class property, specifically office, and it's non-performing, it's probably because there's a lot better competition out there. And the reason why A class office is still at a very low vacancy, is because it's highly amenitized. And I mean, they're not really looking at the pricing there. But if you can have, I feel like you can compete directly with them if you're providing very similar amenities and having it at a lower price per square foot.
Yeah, that's a great view. A little bit of a contrarian view. And it's probably because you are operating in that space and see those opportunities. So I appreciate you bringing that to the table. If I were to answer that question, I would follow the jobs, I would follow the schools, and I would follow the infrastructure development that we've talked about today. I can't tell you what asset class to necessarily focus on, because I think that is extremely dependent on your goals, your time frames, and your knowledge and experience up to this point. Those are all questions that we can help answer and can help direct and bring ideas to our clients. And we do that on a regular basis. So please do reach out to us if you have any questions in regards to those asset classes that we mentioned, areas that we think are ripe for growth and development. We would be happy to have that conversation with you. All right, moving on to some awesome events that we've got coming up here. Katie, tell us a little bit about the Together We Win golf tournament that's coming up in just about a month.
Yeah, just about a month. Is our third annual Together We Win golf tournament benefiting Operation Breakthrough, which is an incredible organization right here in Kansas City. They help roughly about 700 families at their 31st and Truce location every day. So really cool organization. I'm glad that we get to help them. But we do have a few sponsorships and teams still available. It'll be Monday, September 23rd at the Country Club of Leawood. It's a 4-person scramble, 12 p.m. noon shotgun start. It comes with the Bloody Mary bar. You get your box lunches. You get fed really well. There will be lots of opportunities to consume adult beverages if you prefer on the course. So overall, it's a great day and it benefits a great cause. So like I said, we're cutting off sponsorships at the end of this week to get everything together. So there's very few of those left along with the team. So
absolutely. It's a great event. It's a lot of fun. Please do reach out to us if you're interested in playing. We keep it moving. You're not going to be there for 6, 7, 8 hours, typically done by 5 o'clock, 5:30, so you can get home and get hydrated. But it's a great time and it's benefiting a great cause. And there'll be some really good golf played there too. So excited for that event. On top of that, we've got a bunch of different meetups coming up here shortly. One tomorrow. So if you're in town, please stop by and speak with us at the Intercontinental Hotel at the Oak Bar from 4:15 to 6:15 following the Multifamily Interface Kansas City Conference. We will be there, and it will be a great time. After that, we have our September meetup and October meetup back on regular scheduling and programming at Strang Hall from 3 to 6 p.m. One event that I do not see on here is the CCC event, and we will be posting more about that coming up in October as well. I believe, I don't know the exact date, but we have the CCC event coming up in October, which is another great place to come meet and network with a lot of individuals. And then we also have our cash flow summit that I will be speaking at and or emceeing the whole event on October 23rd at the Sheraton in Overland Park. So join myself, a lot of great speakers that will be there. I've brought in a lot of speakers to come to this conference, and we're going to be talking about cash flow. And I will specifically be talking about Kansas City and why so many folks are targeting the Midwest for their next investment opportunities. So definitely check out the Cash Flow Summit. Go to cfsummit24.com. Use the promo code Logan for a special discount. Don't know what that discount is, but it is special, I will tell you. All right. If you are excited about what we're talking about today and or you have other topics that you would like for us to cover, again, we will be definitely diving into capital markets here over the next couple weeks and having Rob Meehan come on and speak about the capital markets the week of September 18th when the Federal Reserve is coming out with their latest meeting report. So definitely reach out to us. You can find us at XChangeCRE.com. Follow us on LinkedIn. And definitely reach out to myself or Katie or Nathan. We have some new listings that will be coming out here, hopefully in the next couple of weeks. We've got some off-market multifamily deals. Nathan is working hard on the flex industrial space. If you're interested in understanding if you should lease or sell or refinance, need a comprehensive review of your portfolio in regards to return on equity, these are all things that we are doing for our clients on a regular basis. So it's our job here on the Market Pulse to continue to bring you the most up-to-date information in real time and what we are hearing so that you can position your portfolio accordingly. Katie, Nathan, do you have any closing thoughts before we sign off here?
I think we're all set. Thank you.
Yes. Thanks for having us.
Fantastic. I appreciate you all being here. Thank you for tuning in. We'll be here live again in 2 weeks. Always coming here live on LinkedIn as well as YouTube. If you missed this recording, this is going to be live on YouTube as well, where you can find the full recording. Make sure to reach out to us, get on our mailing list, because we snip these things down and put great snippets and have slides available for your review as well. So thank you all for tuning in. We'll see you next time.
See you.